Welcome back. The Q&A part of this month's Legacy Planning webinar on charitable remainder trusts. I'm John Mitchell, and I serve as Executive Director and CEO of Ardenwood here in San Francisco. Thank you again for participating in the fourth segment of this six-part series and for joining us today. You know, it's National Estate Planning Week. Who knew? So here are two interesting tidbits from a recent survey by caring.com out of Charlotte, North Carolina. I'll share more in the session next month, but here's two. First, almost 2/3 of Americans believe that having a will is somewhat or very important, yet only 1/3 actually have estate planning documents. Second, nearly 1 in 5 people, 18%, do not know what an advanced healthcare directive is. So let's make sure you're not one of the 18%, please. An advanced healthcare directive, once again, provides guidance for your family and healthcare professionals in the event that you can no longer make your own healthcare decisions. The directive takes the pressure of making difficult decisions away from your family members. We will always emphasize the importance of this document. It's just vital. And finally, the content shared is only informational and is not intended to be legal advice. A replay of this webinar will be available on our website tomorrow. As a reminder, you can ask questions using the Q&A button at the bottom of your screen. Only we will see the questions. Now, let me reintroduce Rick Bailey and Jim Maher. Rick Bailey is the founder and chairman of Camas, and is one of the most highly renowned estate planners in the United States. As a certified financial planner, or CFP, with a master's degree in accountancy and taxation, as well as a Juris Doctorate, or JD, Rick Bailey is a highly valuable asset to private clients, CPAs, attorneys, financial advisors, and life insurance professionals for his expertise in advanced estate planning and case design. Jim Maher is a certified senior advisor and a broker consultant specializing in Medicare. He has been helping individuals and companies navigate Medicare since 1989. Jim is also a certified long-term care insurance strategist. As you know, and I've shared before, Jim has talked to well over 1,000 Christian Scientists since our first webinar a year ago, answering innumerable questions about Medicare, long-term care insurance, and estate planning. So let's get started. I have several questions from Tuesday's session, so let's go with them. Ready? Here we go.
We're ready.
Excellent. First up, does the charity get any benefit from the CRT while the donor is still alive, or does the charity have to wait until the donor passes? Or I love this, when the gift matures. If that isn't the biggest euphemism, when the gift matures. Anyway, Rick.
It really, for a charitable remainder trust, the benefit doesn't go to the charity until the donor passes. And so this is where we get into other types of planning. And I have a lot of clients that want to give during life as well as at death. So the charitable remainder trust covers that part that will go to the charity at death and provide income back to the donor during life. But if we're looking to add, pass on some of that charitable donation during life, we can use direct gifts to the charity, donor advised funds, or what we'll talk about next month is the charitable lead trust. So there's strategies, and I have a lot of clients that want to do both. And so we just want to make sure that it's a fit. But the charitable remainder trust, the charity won't get that benefit until the death of the donor.
We're seeing a lot more activity of donor advised funds. Are you seeing that as well, or setting those up actually?
Yeah, we do set them up, and we see a lot of it happening. I think it's a great tool. From a tax perspective, it allows you to get a bigger tax deduction, kind of basically bring all those tax deductions into 1 year, and then give out that money to the charities over time. And it's a great way to bring the kids and grandkids into that into that charitable mindset. So yes, I think they're a great tool.
Excellent. Okay, question number 2. Is there one charity per charitable remainder trust or CRT, or can you have multiple charities within one CRT?
The answer is we can have multiple charities in one CRT. Now, this goes back to when the trust is drafted, the donor has to make a decision at that point. Do they want to make the charity revocable or irrevocable? If they make it irrevocable, they can't make any changes. If it's revocable, they can change the charities, add multiple charities, change that over time. And I tend to find that clients do want to give to more than one charity. That's not unusual. So the real answer is you can have multiple charities with one charitable remainder trust.
What percentage of these CRTs are revocable versus irrevocable? And what is the tax differential in that case?
The taxes don't change. So it's purely it's for the client or the donor to make that. Do they want, if they've got a long history giving to that charity, then I tend to find they don't have a problem making it irrevocable. But if it's one where they're somewhat new to charitable planning, they like the flexibility. And I would probably say maybe 3/4 are revocable, 1/4 of them are irrevocable.
Okay, that's what I was kind of guessing. Interesting. Yeah. Question number 3. How is the annuity taxed to the donor each year?
Okay, that's one of the little bit more complicated answers. So here's what we have to do. We have to take a step back and look at how that asset would be treated tax-wise if they sold it without the charitable trust in place. So we go ahead and do that, phantom sale, figure out what the gain is going to be, and then figure out how much of that gain would be ordinary income, capital gains, and then non-taxable or return of basis. We keep those layers. Now we take those layers into the charitable remainder trust. And when we're making those annuity payments, remember what you need to remember is worst in, first out. So worst layer first tax-wise. And so the first layer is ordinary income on those payments, then capital gains, then everything else is non-taxable. So let's look at an example. Let's say we were selling that property prior to putting it in the charitable trust. And for ease, so I can do zeros in my head, let's say it's $1 million fair market value that we're going to create an annuity of $100,000 per year. When we sell that $1 million property, if we were to sell it outside of the trust, let's say that would generate $200,000 of ordinary income, $600,000 of capital gain, and everything else would be return of basis. So now we're paying out $100,000 a month as the annuity payment. So the first 2 payments or $200,000 would be treated as ordinary income. The next 6 payments or $600,000 would be treated as capital gains. And then everything after that would be tax-free. So really what it is, the longer that trust is in place, the more tax-free money we'll distribute.
Interesting. Great. Next up, if the donor is already past retirement and therefore has a lower income, what happens if the charitable deduction cannot all be used up within the 6-year period?
Whatever's not used after 6 years or 6 tax returns, that whatever's left is forfeited. It's gone. It's one, in all of my years of doing this, I've never had a client not use up the charitable deduction. And typically it gets used in the first 1 to 2 years and maybe 3 years of on the outside. But it's one, if I have a client that's retired, maybe it's one we accelerate some retirement income and pull it into a year taxable to use up the rest of that deduction. But for the most part, I would say within the first 3 years, we're going to use up that deduction. Hypothetically, yes, after 6 years, you'd lose whatever's left. But like I said, I've never seen it in all my years of practicing.
Next up, what do I do if I want to sell several rental properties, but I don't want to sell them all at the same time?
So there again, it goes back to how we set up the trust. So there's two ways to set up a charitable remainder trust. There's what's called the charitable remainder annuity trust. And so a CRAT, if you want to, keep that in your head. So with an annuity trust, that is set up for one property. And when we set that annuity payment in place, so if it was 6% of $1 million, that 60,000 will pay out every year, no matter what. We can also set up what's called a charitable remainder unit trust. And with a unit trust, we have more flexibility. And so what happens in a unit trust, the 6%, if that's our annuity payout amount, that's based off the January 1st value every year. So if you think about it, if I add property, which I can now do in a unit trust, January 1, I revalue it. So now I've got 6% of a higher number. So it's for a lot of clients that are selling real estate, we'll set up more likely than not a unit trust so that we can sell property over multiple years without having to set up another charitable trust. So it all goes back into the planning of just making sure we know what the plan is or what the goals will be so that we can plan accordingly.
Perfect. Wow. Can I change the charity after the CRT is set up?
That goes back to whether you set it up as a revocable or irrevocable beneficiary designation. There again, if there's a chance that you might change it, let's make sure it's revocable. But if you've made an irrevocable charitable designation, charity designation, then you're stuck. And so really goes back to how you set it up originally.
Perfect. Now, this is the last question we have. I don't know if those listening today would like to ask a question, but this is a little bit shorter than our usual Q&A. I know and unusual again on Tuesday, we didn't go to questions. We had to conclude the program after the presentation. But if anyone has a question, I would encourage them to submit one in the next few minutes. Next up, can the donor receive any of the principal of the CRT?
Easy answer is no. And it really comes back to when we're planning this, because we're setting up this through the IRS calculations and requirements from the tax code. When we set up the charitable trust, the gifts are locked, are basically in your mind think that they're locked in because they should be. And so you're going to get that annual income payment, but the principal needs to stay in the trust. And so it's one, can you break it? You can with permission of the charity, but the charity is going to receive the bulk of that principal payment. And so when you go into this, go into it with the mindset that all principal goes to the charity, the income comes back to you as the donor.
Interesting. Here's a new question. Can a 401k be moved into the trust? If so, how are the required minimum distributions made?
I don't have to answer the second part of that question because the first part is no. We don't want to put qualified, accounts in there, 401ks, IRAs, any of those types of assets. Those don't fit in a charitable remainder trust because of the distribution rules, the tax rules. If you want to donate, part of your 401k or IRA to charity, I would recommend making that a direct contribution to charity. And what we'll talk about again next month with the charitable lead trust. The charitable lead trust, for a lot of qualified plans where I've got a lot of clients that are taking required minimum distributions that they don't need or don't want. but they have to take them out. So we'll use a charitable lead trust to offset some of that tax hit that's coming. It's also good for stock options that are being exercised. But it's one, if you think about this, the reason a qualified plan doesn't work is because we have to be able to move an asset in that is going to be subject to, that we can sell. And so that doesn't fit for a qualified plan or exercising stock options. So charitable remainder trusts work great for those assets. Qualified plans, stock options, charitable lead trust, and we'll have examples of that next month as well.
Excellent. Jim, do you have something you want? You're muted, Jim.
Rick, what we often get asked too, a lot of clients always bring up, what about my adult children, right? A lot of adult children come into the charity game and say, listen, I really, I know mom and dad are charitably inclined, but quite honestly, what about us, right? I mean, you've seen that with 3 siblings, 2 siblings. It always seems to be adult children really want to see their parents take care of charities, but they don't want them to forget about themselves. How do you address that with the charitable remainder trust?
At the end of the presentation on Tuesday, we talked about the life insurance component that comes in here. So that replacement life insurance is where we take care of the adult children or the grandchildren. Okay. And create that legacy. And here's what I like about this kind of planning. And I just went through this with a client that has, she's got a lot of charitable intent, but at the same time, she did want to take care of children, grandchildren. And so we're giving a lot of money to charity in her plan, some through a charitable remainder trust, some through a private foundation. But then we're going out and buying life insurance on her life and putting that into a trust, so it'll distribute to the kids and grandkids, income tax and estate tax free. So what I like about that replacement insurance, if you follow through the tax benefits here, one is you're able to use the charitable remainder trust to eliminate current income tax. You're able to receive a larger stream of income back for your life. And if you think about it, with that increase in income and the savings of the tax deductions, that's going to help pay for a lot of that life insurance, or in some cases may pay for the life insurance. Then at death, the charity gets the remainder of the charitable trust. You've made that great gift to charity. And now the kids, instead of having to sell the property at death, sometimes at a reduced cost, now we're passing them an asset that's income tax free, estate tax free, and very easy to pass on to the next generation. So that's how we really take care of that next generation, is through the life insurance planning.
Okay. Is there an age cutoff with some insurance companies, like from dealing with a lot of Christian Scientists in their 70s and 80s? What happens if you're 85 or 86? Can they still qualify for that plan you're talking about?
We can actually go up to 90 now on life insurance.
Okay.
It really comes down to, people are living longer, and those that are taking care of themselves are living healthier too. And the insurance companies note that. And so if you're healthy, age, when I first got into using the life insurance and the planning, I have to say 65 was old. That was
say
old.
that anymore.
Just so you know, 65 doesn't look old anymore.
No.
And from a planning standpoint, we've moved that needle from 65 to above 80.
Okay.
So it can still make sense, for the planning, and it can still make sense economically. Right. And so we just want to go through that. But yes, if you're healthy, and that age is not as big of an issue.
And just to further that, because I get asked this, so I'm kind of passing on to you because you're the insurance expert. So in order to do that, do you have to submit money or anything with how do you take someone through the process? Do they have to give you money? Do they do the application? In other words, how do they get insured? I think people want to understand that process.
So the process, when you apply for insurance, you're going to fill out an application. No money goes in at that point. And what we're looking for we're actually looking for offers from the life insurance company. So we're going through the underwriting process. They're looking at your health. They're looking at your financial ability for the need for the insurance and the ability to pay for the insurance. Once you go through the underwriting, the insurance company comes back with an offer. Now it's up to the client. Do they want to accept that offer? Or do they want to accept something less than that offer? So it's one where sometimes we may underwrite for $1 million, but when it comes back, we, through the process, we realize we only need 500,000 of death benefit. So we only accept 500,000. So it's a no cost underwriting process. So no money comes from the client until we're ready to accept that offer, and then we bind that insurance.
Okay.
And it's one from the charitable trust planning. And this is something if we want to take care of the kids as part of the trust planning. And I've got a client that I'm working on right now that they actually sold the property faster than they planned on. And typically what we want to know is if we have to have insurance in place to take care of the kids and grandkids, we want that insurance in place at the time we put the property into the trust. So going back to your question earlier, John, if, let's take a worst case scenario. Client sets up the trust, they put the property in today, but they don't buy the insurance and have it in place at today. They die tomorrow, the kids get zero because there was no life insurance in place, and the charity got whatever was left in the trust. And so we want to make sure the timing is perfect. And so if we need to take care of the kids and grandkids with the insurance, we want that in place at the time we put the property into the trust.
Rick, I absolutely love that because, and this is so important, and I'll address it from the perspective of the charity. There is nothing more awkward or worse than being put in the position of the family members or the children and grandchildren, whatever, looking to us saying that there might have been undue influence or whatever, that the charity benefited, yet the family did not. Mm-hmm. And then that was not communicated. We're always talking about communication and transparency and so on. If that was not communicated by the individual, it's unnecessary and awkward. And so I think the insurance piece is just brilliant, truly.
Well, and that is the case. I've been in the situation where it gets awkward. We don't want any of this planning to be awkward. We don't want to feel like, we don't want anybody to feel forced into any of this.
Yes.
I would rather take our time, go back through it as many times as we need to make sure it's perfect. Make sure it's what everybody wants. Now, when I say everybody, we're talking to mom and dad. They're deciding what they want to pass on to the kids. And sometimes they give more to charity, less to their kids, because that's what they want. Now, what I'll also tell mom and dad at that point is write a letter, put a letter in your estate planning documents that says, this is why we did our plan this way.
Yes. Or
sit the kids down and talk to them and say, this is why we're doing it. Especially when it comes to charitable planning, mom and, it's usually not a secret that mom and dad want to do charitable planning. The kids have seen that typically over time. And so it's part of what they would have expected. But if it's a little bit unusual, let's explain it to the kids so it's not a shock when it happens, because you're right. They turn to who got the money. And if the charity got the money and they didn't, they want to blame somebody, and mom and dad aren't there to talk to. So let's address those problems up front, so that when mom and dad pass on, it's a celebration of life, not a time to fight.
Exactly. Beautifully stated. I like to think of estate planning as wonderful, a wonderful tool, but not a weapon.
No.
This is not, it's just a wonderful opportunity through our tax code and a nice provision. Thank you for that. Next up, here's a good one. I'm sure this is on everybody's mind. How much does it cost to set up a charitable remainder trust?
After the planning is put together, the actual trust, you're typically looking somewhere, I would say 1,500 to a high end of 3,000 to put the trust in place. But typically that 1,500, 2,000 is more reasonable. And because there again, these aren't complicated trusts and there's not a lot of decisions being made. So it's one, I don't want to say cookie cutter is the right word, but not far off.
Okay.
So it's very, very vanilla planning. And I like this from the standpoint of the IRS, what Congress has given us. This is very, very safe planning from a tax perspective. As long as you don't abuse the trust, everything's, there's no issues. And the cost is minimal to get this in place.
Okay. That's great. I love what you said too about, wanting to get it perfect or really take your time and think this through. What is that thing for a carpenter? You measure twice and cut once.
Yep.
Type thing to really get it right, because we've had a couple of trusts that were put together. The individual didn't really want to spend the time or actually more of the money to get a professional in place.
Right.
And so the trust had to be reformed. And oh my golly, it was a mess. And if that individual would have known the cost and the time involved, they would have done it right up front.
Yeah. And it's one as you go through, and I'm finishing up a client's their case right now. And it was one where we started out with a brother and sister. They're joint owners on some property. We went through all the planning separately with the brother. And then we went through it all separately with the sister. The brother, it was a perfect fit for his planning. The sister, I have to admit, I got the feeling on the very first meeting it wasn't probably going to be a fit, but she kicked the tires. It took her about 6 months to finally decide this wasn't the right planning for her. But it was good that she went through it, just from the standpoint, I think she still wants to do charitable planning, but timing now is not right. So do it when it's right. Take the time to get the trust drafted properly. Because if there's a mess, if it's not done right, either the kids are going to take the brunt of that or the charity is. You're not going to get the result that good feeling of giving to charity may not be there.
And so you send out like a worksheet or like a series of questions for them so that so people can start thinking it through before they sit down and talk with you.
Yeah. It's one, we take it from a conceptual standpoint first. So it's one of, what I'll do is send out the information, the request for information will be, tell me about, your assets, what your goals are. Then we'll take it from a conceptual standpoint as we narrow it down to the specific. But want to make sure that you understand conceptually what it does first so that it fits. Now it's one where I deal with these on a daily basis. And so it becomes somewhat routine for me to go through it. I try to take it from a client's perspective. This is the first time they've ever seen it. And it's not complicated, it's new. And now I want to get it to where you understand it enough that you can go draw it out for your neighbor. And if we get to that point, and we will, then you understand what it is and you understand what a benefit it is for you and your family. And that's what we want to get it to.
Perfect.
I have another question, Rick. So what if I have an attorney that I'm working with? Do you work with that attorney? And second of all, what if I don't know anybody? This is new to me. Do you have attorneys that you can recommend, whether I'm living in California or Massachusetts or Idaho? How does that work?
If you've got an attorney, we're happy to work with your attorney and make sure it's done right. And a lot of times I'll have attorneys that say, this isn't something I understand. and they don't want to be involved in the drafting. That's okay too. If you don't have an attorney, we've got an attorney network that we use all over the country. So we can find an attorney, either real close to you, or, use one that's, maybe long distance, but, over the internet now, everybody's close. But yeah, we can definitely get the right people in there. And the other one is from a tax, preparation standpoint, is your CPA wanting to do the charitable remainder trust tax return? Because there is a return due every year. And some CPAs are happy to do that. Others, that's not something they do. So they don't want to do the charitable trust return. So we have CPAs that we can recommend just to do that portion of it.
Boy, that's huge as well.
Yeah.
This is where you want the right people in the room.
Right.
Yeah.
Next up, is a trust only for wealthy people, or is it a good idea for anyone of any means? In other words, do you need a certain amount of savings to set up a trust or a CRT?
If you're doing a charitable remainder trust, it really is one you're going to have you're going to have a larger taxable event. That's usually what drives it, or you want to create a stream of income. So it's not one that you have to be super wealthy to do them. It's just, does it fit? So when we go through that planning, and if you're thinking that this might be a fit, the best thing is let's have the conversation, because we want to make sure it fits. If it's not the right strategy, we've got other tools that we can use, direct gifts, donor advised funds, those types of things may work better. So it really comes down to the situation. But no, I work with clients of all different means. And it's interesting, I talk to a lot of clients that don't think they're wealthy. Well, they may be wealthy, they just they live below their means.
Right.
And so they aren't living the lifestyle that they think is the wealthy, but they do have the assets and income to do a charitable remainder trust. So it really is, as we go through your planning, we'll look at it. If it's not a fit, I'll be the first one to tell you don't do it. Because if it's not a fit, I don't want to be the one there, explaining to somebody why it was done.
Right.
So we'll talk it through, and if it's not a fit, we'll go to the other strategies that probably work better.
Perfect. Excellent. Next up, is the money in the trust no longer part of the donor's estate?
Yes, that is correct. Once we put it into the trust, that principal now belongs to the trust. It's an irrevocable trust. So that will no longer be part of your estate tax calculation. So this is where we will use this for estate tax planning and to create that income. But that is a nice way to move things out of your taxable estate.
Excellent. Now, this is the last question. If there's anybody in our audience that would like to submit one, please, as I say, send it to us, send it to me. Next up, give realized stocks as give realized stocks as gift. You get full tax deduction. If put into a trust that gives 6% interest, how is tax deduction handled? Realized stocks as gift. I guess she's saying give appreciated stocks as gift, you get the full deduction.
Okay, I think
not stating that very clearly. Yeah.
There. So when we're donating the stock, so when we're donating that asset to the charitable remainder trust, the deduction is based off the fair market value of that stock. So let's use an example. Let's use cryptocurrency, which nobody understands and everybody loves to hear about it. Cryptocurrency now, let's say you bought it for $100 and today it's worth $20 million. When you put that into the trust, it's the charitable deduction would be based off the $20 million, not the $100 that you bought it for. So you get a deduction based off the full fair market value. Now, when we're taking the income out, it's going to be 6% of that fair market value, if that's the annuity percentage that we put. So if it was $20 million, 6%, we take out what, 1.2 million per year? Is my math right? And so it really is one where that's why this is such a great tool for appreciated property. If you were to sell it, and I've worked with clients that have bought cryptocurrency, and it's like they won the lottery. They bought it for very little and it's worth a fortune today. When they put it in, that gain, that taxable gain, is swallowed up inside the trust and not reported. And then you can turn that on and start having that income to live on in retirement or whatever you want it to be. And then, so it's a great way to eliminate that high tax event and be able to create the income to live on.
Are you getting a lot more discussion on or questions about cryptocurrency, Rick?
I'm getting a lot more, and I understand it about as good as everybody else does. But it is one, I'm seeing a lot more on cryptocurrency. In fact, just started talking to a new client yesterday, and those numbers that I said just weren't off the top of my head. They're actually that client's numbers. It was $100 up to $20 million is the gain.
Well, I know that Goldman Sachs has now created, it's considered by Goldman Sachs an asset class.
Yep.
An official
that
asset.
I still don't understand. So, but no, it's, and that's the great thing of the charitable trust. It really is a way to, if you think about cryptocurrency, you think about rental real estate, you think about some of your investments, you've built that up over years to create that asset. Now we want to create, now it's retirement years. Now we want to change that asset to income. Well, if you don't plan for it, then Uncle Sam takes a big chunk away from you in that transaction. What we want to do is keep that full principal balance and create that income for you during life. And instead of giving that big chunk to Uncle Sam, we're going to give it to the charity, your charity, the charity that you're involved with. So it's a great way to take care of mom and dad in their retirement years. It's a great way to pass on an endowment size gift to a charity. And then if we need to provide that, life insurance, back to the kids and grandkids to make sure they're taken care of. But it can be a life-changing gift to a charity with the size of endowment money that we can pass on.
Absolutely. Yes. And yeah, totally. It makes such a difference. And good planning is just everyone wins with good planning. That's why we're having this series, actually, as we know. Last question that we have. What is the least amount of money to open a charitable remainder trust?
I would probably say, I've done them as low as 100,000. And it's one where I would say economically, we can probably go lower than that, but it's one. I mean, if it's $100,000 asset sale in California, that might be getting taxed at 50%. So we're saving half the asset in the charitable remainder trust. So I would say, I would tell most people 100,000 to be the low end.
Okay. Well, that's all of the questions that we have. Just grateful for these seminars and all good questions. And thank you, Rick and Jim, for answering them. This was just great. And thank you all again for joining us today. We look forward to seeing you next month to address another aspect of legacy planning, as Rick mentioned, charitable lead trusts. Very interesting. Charitable lead trusts are quite valuable tools. The dates are Tuesday, November 16th and Thursday, November 18th, again for the Q&A portion at 4 p.m. Pacific. So please register today. And remember, our second Medicare webinar, we did one last week, as you know, two of them, 2 sessions, Q&A and regular. informational, is next month. It'll be coming up with Jim Maher again and Leslie DeFrisco on Tuesday, November 9th, and then Q&A on Thursday, November 11th. You'll receive an email about these webinars next week, and you can register on our website, ardenwood.org. So please invite your friends, and goodbye for now. Thank you all.
Everybody.